All right. Well, hello, everyone. Mike Craig here with Steeple Rock Partners. And today we're going to be talking about the Steeple Rock Partners or the SRP debt fund and how it works and some of the questions we need to be asking as investors in this opportunity. Kirk Avery is the other half of Steeple Rock Partners. Unfortunately, he's not with us today, but I want to say we're really excited about this opportunity. If you know Steeple Rock Partners, you guys know that we have been since 2017 investing in multifamily apartments, self-storage. We've recently done some really exciting hospitality investments with Marriott and Hilton and a few other investments. We really are a real estate investment company based here in Austin, Texas. And we look for opportunities among a number of partners that we have around the United States in these specific asset classes that we really want to invest in. And so we're excited about this debt fund. This is one that actually we have several friends and colleagues who are also fund managers in this fund. We've known Passive Investing, who is our partner in this opportunity, for several years. We've done a few multifamily investments with them, and we've had a couple of really nice exits with them. So they're folks that we trust. Dan Hanford, who's in Columbia, South Carolina. He can't be with us today, actually, on this call, but we got Danny Randazzo and Kelly Garrett with us. They will be kind of walking us through how this works. But really excited about this. And with that, I think, Danny, I will turn it over to you and you can kind of walk us through the debt fund.
Perfect. Yeah. I am Danny Randazzo. Grateful to be here with you, Mike, on another new and exciting opportunity. The debt fund was really born out of an investor demand. At the end of the day, just like all of you, we're investors in each and every one of these deals, and we're active investors within this debt fund. And it's a great balance between, the traditional multifamily or self-storage or even hospitality investment is a longer term kind of locked up your money until that deal exits or until there's a capital event sometime in the future. And then this debt fund opportunity is the exact opposite of that. It's a short-term investment. There's a 90-day liquidity period. So if an investor ever needs access to some or all of their money, then you can make that request. And, typically we're kind of getting those investor requests handled and funded within a couple of weeks, but it may take up to 90 days. So it's that great balance of, cash flow from the returns, and we'll kind of get into that here in just a second, but paired with that short-term investment where, as the investor, I love being able to have access to my money when I need it. So I personally love this, and it's just a great balance between long-term and having some short-term liquid investments in your personal portfolio. With that being said, I'm Danny Randazzo. I am one of the managing partners along with Dan Hanford at PassiveInvesting.com. So if some of you have been investors in previous deals, as Mike had mentioned, in some of our multifamily deals together, welcome back, and hopefully you can join us with this opportunity. My role really with the debt fund, along with Dan, is managing all of our investor relations side of the business. There's really kind of two components. It's the equity side and the equity management. When you have an open-ended fund like this, we're constantly, getting new investors in. We are handling any investor liquidations that need to take place, and then also managing, new loans going out and old loans paying off. And so it's a constant kind of money management system. And I'm grateful to have Kelly here on the call with us. She lives just down the street from me in Charleston. I've lived in Charleston for about 7 years now with my wife, our 2 kids, and we've got a golden doodle dog named George. So we live right downtown in Charleston, love to walk downtown to the restaurants, to the coffee shops. I I joke with people that our household probably drives about 1 mile per day, and so we love the small town, hometown, city feel, and just being able to navigate that. But again, grateful to have Kelly here. She really runs our rehab wallet side of the business. So Kelly is the borrower facing and loan originator, loan servicer, and handles anything to do with the loans getting funded, loans being serviced, and loans being paid off. So Kelly, give us a quick intro on you, and then we'll keep things moving here.
Thanks, Danny. I too am grateful to be here. As Danny stated, I live in Charleston, South Carolina, and been in the mortgage business probably 2 decades, close to 2 decades, in and out of a formal mortgage brokerage did some private lending. And then we kind of morphed into Rehab Wallet. So Danny and I obviously are good friends on top of being partners and colleagues, but we were walking one day and he'd asked me how things were going. And I said, you know what, my private lending side of our business, I was like, my phone is ringing off the hook, but I'm out of money. And so we kind of came up with the idea that if he and Dan out inside passiveinvesting.com could raise the funds, I could put it on the street. I've been involved again. Not only did I have a mortgage brokerage and been in the mortgage business for a long time, I also flipped for 18 years. So I was ingrained into the flipping world. And so I know the ins and outs of what it takes to be a flipper in the single family world. And primarily that's what we do. So my job every day was initially was to put the money on the street and grow that team. So kind of takes us, Danny, into the rest of the recording here, but more so than anything is that we just want to be able to establish there's a large team behind us to being able to do some very rock star people behind us that's dedicated to our team. So I'll let you go over this, Danny, as to kind of explain our team.
Yeah. The other important thing to highlight, Kelly's always very modest, but when she says she has flipped houses in the past, she has personally flipped over 200 houses. So this is buying, rehabbing, selling them off, or flipping them into long-term rentals. So a massive, massive amount of experience. I have personally flipped one house, and that was enough lesson for me to learn I needed to go more into the larger multifamily side of things. But Kelly's background is excellent to manage these borrowers. But not only, do we have Kelly, myself, and Dan, but we've got this entire great team behind us. Mostly on that kind of top row and into that middle row, we have all of our Rehab Wallet team members, from the managing director, Angela, who does a great job coordinating with all of our team members. We've got operations people, sales people, which are, working with borrowers to size loans, review loans, compliance manager to make sure things are in check, and then financial coordinators, loan processors. We have our marketing team, and of course our finance and investor relations side of the house too. And so, we are set up as a premier lender in the space. We have great reputation, and we do a great job of not only working with borrowers, but also managing the business as well. We have a phenomenal institutional quality mortgage software that we use to track and maintain things. And we'll get into how the fund works here in just a second, but huge thanks to our team of dedicated experts who do a great job managing the day-to-day of the operations. A quick disclaimer before we get any further. This investment opportunity is open to accredited investors only. It is a 506C like Charlie offering under the SEC Regulation D. If you're not sure what an accredited investor is, always follow up with Mike to help you. But it's a person having a net worth of $1 million or more, not including their primary residence. Or if you're an individual, 200,000 in annual income over the last 2 years and a reasonable expectation that continues. Or if you are married, it's 300,000 or more over the last 2 years with a reasonable expectation that that will continue. Another very important disclaimer, you as the investor, you are in charge of making your own decisions. We are not soliciting any sort of security here. We are not your attorney, your CPA, your advisor, your financial advisor. So please consult with your attorney, your CPA, or your professional financial advisor prior to making any decision to invest. How the investment actually works. So if you are an investor and you put $100,000 or more into the fund, you will earn an 8% preferred return. You can either get that return paid out on a monthly basis with a direct deposit into your bank account, or you can elect to have that return compounded in your investment and basically wait until the future when you need the funds back, or if you need to liquidate ever, you would get your initial capital contribution plus any unpaid preferred return. I mentioned the 90-day liquidity piece. It's a great short-term investment. If you need to put your money in and have access to it, I personally use the debt fund as kind of that rainy day fund where it's, having 12 months of your living expenses saved up, keep it in the debt fund, let it earn an 8% return while you don't need access to it, and let the power of compound interest really build and let your capital accumulate and grow over time. So really happy with how the investment works. Investors earn the first 8% before there's any sort of general partner split that goes out. So it's a very secure and stable investment opportunity to have that preferred return first. Kelly, I'm going to have you kind of cover how the fund works, how capital is protected, and then why we like the fund.
All right, sure will. So obviously, we're here to vet our borrowers to ensure that, we're putting these loans with the right people. So their experience and their references are and ability to pay is a big deal to who we actually lend with. When we're underwriting a loan, we want to look at a few things, and the main thing is the borrower's experience. That alongside is that if we had to take that investment back, that it would be something that we would want back in our portfolio. So like I said, like Danny had said, I flipped hundreds and hundreds of properties, and a few of our teammates have also flipped some deals. So I always put that back out, especially to our originator. Our originator, who is our gatekeeper, has over 2 decades of experience herself in the mortgage business, has worked for me in my mortgage brokerage, about 2010. She knows our culture, our culture, as well as she knows what we would want back if we had to take something back. Because things happen, right? Life happens. Things happen that we actually will have to do that at some point. We definitely look at low leverage. That's the main thing right now. We started out at Rehab Wallet at 75% after repair value, and we've moved that down to 70%. When the market changes and make some changes, I've been through the crash of 2008, 9, and 10. So is Anna, our gatekeeper, and our eyes are wide open to the possibility of these values coming down. So if something happens, we're well ahead of it, or we try to be well ahead of it to adjust our LTVs. But right now they're sitting about 70% LTV. We feel good there. The loans come in, obviously, we hold back the draws for the rehab. They have to send us videos or pictures walking straight in from the street, from the mailbox to the street number to the house, to make sure we're in the right house when they're giving us these actually inspections is what you want to call it. And then from there, we're able to ACH their rehab back using their scope of work that they sent in, and we're able to put that ACH money in their bank account by the end of the business day. There's a lot of things that we started at Rehab Wallet, do some things that I didn't like when I used hard money lending as a flipper myself. So the one big thing was waiting week to 10 days on my draw money. That was a big deal. You'd have to wait on inspectors to come out back in the day prior to a lot of, these phones and such when I was flipping in the early 2000s as well. So we've learned how to work through videos, work through pictures to fund it correctly. We do short-term loans. We like 6 to 9 months. That's just what we like to do. This money's out and back in within 6 months. It's protected. The investors' monies are coming in alongside Dan, Danny, and myself. We're all invested in the fund, and we're all in first lien positions. That's the main thing. So when your money's coming in, it's not invested with one borrower, because something possibly could happen with that one borrower. So what we like to do is spread that over all the collateralized loans that we have, and we'll go over that in a second. But we have about 250 loans right now on the street. After this month, they're probably closer to 260, 265. It's obviously we have title insurance. Things happen with title, so we ensure that we get title insurance at the closing, which the borrower pays for. Our interest rates starts at 12%. It's upwards of 14%. And why do we like the fund? I mean, who wouldn't, right? If you're getting an 8% return collateralized over hard assets. I mean, some people ask me sometimes about what hard money means. Hard money means it's collateralized against hard assets. And so our money, again, I'm saying ours because we're invested as well as investors, but it's actually collateralized over a lot of different loans, of which we really like. They're personally guaranteed as well. So we close in the name of a company, of an entity, but the borrowers personally guarantee the loans. And the compounding feature is huge. The ROI changes when the monthly compounding feature. If you don't want your distributions, you can keep it in, and the ROI changes. We've historically had a very low default rate. We've had one default in now 3.5 years. We started June of 2020. We're exceptionally proud of that. But so we're excited about seeing where that goes, right? I'm prepared if something happens. I don't want to send this out to make people think that we'll have one default when we've done, almost 1,100 loans. If we have to take some loans back, we will, but I'm not scared of it, right? We'll start a REO division and make that happen. But right now, historically, we've had one default. I'll jump into this performance. Obviously, you can see some before and after pictures. We like this, single family brick ranches. Obviously, we love those. Why? Who doesn't like the 3-2s? So we have some flyers that we might like with some really exceptional borrowers, maybe on some very small multifamily, but typically probably 97% of our fund is in a house that looks just like this. So we funded since inception. This is a big pride moment here when we went over 200 million. 85% of our loans are return borrowers. That says a lot about our team. It makes me so happy to see the same faces and the same entities coming back over and over again. And obviously they've paid their payment, so we let them come back. So we know they're doing the right things. They're paying their payment. They're rehabbing on time. They're rehabbing sufficiently in enough time to be able to then, because think about it, 6 months is not a lot of time to be able to close, pull permits, get the rehab done, and exit. So if they can exit in that 6 to 9 months, and then some people ask me, what happens after the 6 months? Well, we'll give extensions if needed. Obviously that's a fee. So there's a fee for another 3 months. But typically, we don't like to do that, but if we have to do that, we will. And again, down at the bottom, our recovery of our default rates is we've had one, and actually had no deficiency with that. We actually made a little over $42,000 in that default. We went through foreclosure, nobody bid on it. We took it back, and within 48 hours, we had a real estate agent listing it and a full price cash offer, and made with fees, etc.
Yeah, and I think that just speaks to the kind of conservative nature of the fund where we're giving out low leverage loans. And so, if you can give a loan and have a first position lien and be the owner of the property for 70 cents on the dollar, there's a good margin in there if you need to quickly sell the house, or in the event we had to take one property back out of 1,100 loans, we actually made a profit off of that one.
The presence of Rehab Wallet, we like, the Sun Belt really specifically. You can see where we're at. We put a lot of money on the street in the Carolinas, really specifically South Carolina. I'm originally from the upstate of South Carolina, of Greenville area, Greenville, South Carolina. Danny and I both live in Charleston, and Dan lives in Columbia. Our footprint is a heavy footprint in the Charleston Tri-Counties, as well as Columbia, South Carolina. And we'll stay there as long as we can.
Yep. I think that really covers it. Mike, what kind of things did we miss, or what kind of questions are you typically getting from investors that we can help address?
Yes, a couple of questions. So on the liquidity question, you mentioned 90 days. What is I understand that that's actually not the average. Like if someone wanted to cash out or get some of their cash back, what's been the average time to return cash to people?
I think the average is about 12 or 13 days. With where the portfolio is at with 250 loans, we're really closing a loan, or excuse me, originating a loan and probably getting a payoff almost every day with just the volume of things. And so it takes a lot of coordination amongst Kelly's team and our side in terms of equity management and borrower management, but it's much faster than 90 days. The typical average is about 12 to 13 days. But I always tell investors, just make sure you're planning ahead. Don't expect, a 2-week kind of turnaround, but ideally try to get you out as fast as we possibly can. But just know that, there's some seasonality to the business. Things could take a little bit longer. So you can probably give us 30-day heads up. We can make sure to manage that. And of course, we'll try our best to work with needs as they specifically arise.
Excellent. Okay. Another question here is, can I add to the fund? And if so, in what increments?
Yes, you can add to the fund. I think we have $1,000 increment just from a round number perspective. So once you're invested in the fund with at least 25,000 or more, you can always add to that.
Excellent. Okay. The other question is, so I'm a house flipper. I'm in South Carolina. Why is it advantageous for me to come to Rehab Wallet and to the fund? Why is that better than going to a bank or other hard money lenders that are out there?
This question, comes up quite a bit, and it's an interesting one when you really take just a second to think about it. So, Kelly mentioned our typical interest rate, kind of starts at 12%, but more than likely we're probably charging about 14% to the borrower. And the reason they would work with Rehab Wallet and why so many of them do is because the speed in which we're able to close a deal. A lot of the professional real estate investors don't have the luxury to wait 60 days or 90 days for a bank to underwrite them, get their tax returns, check their statement records, and then get an appraisal, and then wait for some bank manager to review it, and then wait for the bank president to put a stamp on it in the closing process. These investors are finding deals and they're getting discounts to buy these properties because they're able to purchase them quickly. And so our typical time frame to from a borrower submitting a request for a loan to us funding that loan could be as quick as a few days. More than likely, we probably close a deal start to finish in about 2 weeks or less. And so time is very important. The other thing that actually has helped us recently is that banks are now charging, probably 9, 10, or 11% to borrow from the bank for this type of investment. And there is really not a major impact to the borrower who's actually flipping the property, whether they're paying 11% or 14%, because it's such a short-term project. The other major component is, time is a risk for these flippers. The longer it takes them, the more they're paying in interest, either to us or another lender. And so if they can do their renovations, have a great lender who quickly addresses their draw request to then fund a little bit more money to complete their renovations, time is a lot more important to them than saving, maybe a couple $100 a month on interest. And so, as Kelly pointed out, we've got an 85% return borrower rate, and it's because we are an excellent lender. We actually try to help these borrowers get their projects done faster. Likely has a little bit more experience in the flipping world than some of our borrowers. And so we just built a great networking community. Not only are we a lender, but we're very knowledgeable about the flipping process, and we help people. And so it's an easy sales pitch. We really don't do a ton of marketing. A ton of our business comes from great borrowers telling their friends and other professionals to come and use us. And it really has kind of sold itself as the premier lender in the Sun Belt for these types of hard money loans.
Excellent. Yeah, I know what it's like to, go to a bank and you have a time crunch on a flip, but you've got all this red tape and bureaucracy, and they're not concerned with your timeline. And so there's definitely a place in the market for this to do this quickly, for sure. Other question. So the fund has been in existence for 3.5 years. Is that right? Have the distributions for the investor, has there been a month where you've missed a month or had a pause for a quarter or anything like that? Like, what's been the experience from the investor since inception on those monthly distributions?
On time, every time.
Excellent. Okay. Let's see, maybe one more here. Let's see, what would have to happen for an investor to be concerned about their capital? I mean, I think you had it in one of those slides earlier. You talked about 50% default rate would have to occur before the capital is threatened. Could you just cover that piece? Because I think as people are thinking about what is my risk, help them understand that piece.
Yeah. So there's probably two risks here. Number one is just the risk of property values. And, when we're giving a 70% loan at the highest loan to value that we would give, the market would have to have a reduction of 30%. And within a short 6-month period in real estate, property values should not change by 30% in a 6-month period, especially in these markets in the Southeast US where there's population growth, there's job growth, and there's very stable local economies to support and sustain existing property values. So that would be one risk, and I feel like we mitigate that exceptionally well by having short-term loans. So if a market or a neighborhood has a property value reduction of maybe 5 or 10%, the next time we go to originate a loan in that area, we've already taken into account that reduction, and our LTV is only going to be based on what the property is worth today. And so
Mhm.
risk is really taken off the table. Now, again, if something wild happens and property values across the entire United States drop by 50% overnight, we don't have any control over that. I don't know any individual in the world who has control over that. And so I feel like we've really mitigated the property value piece by having low leverage loans and short-term loans where we're in and we're out, and we shouldn't experience a 30% reduction to property values in a 6-month period of time. Second risk is really in that distribution component. And so, when we're charging borrowers 14% interest and investors are earning the first 8% on that, roughly, if half of the loans were unpaid, investors would still earn their 8% preferred return because half of the portfolio would be paying, and half of 14 is about 7.5%, but we also charge lender fees. So realistically, we're making, half of 14 is 7, but we're charging some lender fees. So realistically, we're making about 16% interest off of these borrowers. And that's where we get that half or 50% metric. And that's a very important piece to define when you're talking about the capital stack. So investors are first and foremost of any profit that comes in. Investors are getting their return first. The general partner is making money second, but as we saw earlier, we have this whole team of people to pay salaries, pay for software, and pay our expenses. And so, our mindset has always been investors first and, making sure investors are made whole, which is why we've hit, returns every time on time since inception. And I don't foresee that risk coming to fruition based on our historical performance of the loans. Every single loan in our portfolio has performed. We've collected every single cent of interest or fees owed to us over the $220 million plus in loans funded. So something catastrophic would have to happen. And I just don't foresee a real possibility of that. But again, as an investor, I feel very confident in earning my 8% preferred return because, again, the first 8% of profit comes in and it goes 100% to the investors. And then any excess profit that comes in goes to the general partner. And the general partner is then paying all of their operating expenses, all of the payroll for their team, and then hanging on to any extra money that's left over. And so, I think we've built this investment opportunity to be very conservative, very stable, and, just a great setup for investors to earn money, have their capital protected, and have a consistent and predictable outcome with that.
Excellent. I guess the final question would be, how is there like an end date for this type of fund, or is this one that will be open as far as the eye can see? Like, what's the future for this?
The fund is actually set up to be a perpetual fund, so open until we may decide to ever close it in the future. I think the outlook, and based on the demand from our borrowers and the demand from the investors, is paired pretty perfectly right now. I would expect the fund to continue to operate for the next several years to come. And, as Kelly pointed out, when we're doing 6-month, 9-month duration loans, we're very adapt and able to pivot or change the business model. And so when we saw some uncertainties in the global economy, we quickly pulled back the loan to value ratio from 75 to 70% to be much more conservative and being able to really protect our money. Because again, if property values decrease by 10% and we're holding the note at 70%, we still have a nice cushion in there to take the property back and sell it and actually make a profit. And so I think we feel very good about kind of where we're at today. I feel really good about kind of what over the next year ahead. We'd like the fund to continue for many years to come. But we're, of course, constantly monitoring the economy, monitoring what borrowers are doing, monitoring the demand of investors, managing those components. And, I think the fund will be around for quite some time, and we'll always be learning and adapting as we need to, based on obstacles or challenges that get presented to us in the economy and in everyday life.
Awesome. Well, I think it's a really interesting opportunity, and it's really well run. I can see that. We love the team. We really enjoy all of our interactions with the passive investing crew have always been pleasant and wonderful, and we really respect you guys. We love just how thoughtful and detailed you are. And I'm excited about this, and I think our people will be excited as well. I don't think I have any more questions, but if people do have more questions, you can contact me, Mike at steeplerockpartners.com, Kirk at steeplerockpartners.com, and we will deal with those questions and give you some answers. But I think that's really it, Danny and Kelly. Thank you guys so much for your time. Really exciting about this. This is an exciting business and opportunity. So thank you so much. With that, I think we will cap it off. Does that sound good?
Sounds great, Mike. Thank you for having us.
Okay. Thanks, guys.